So thank you everyone for joining us here today for what I've called the rate review. This is going to be a discussion interview as well about where the current rates are, where we can expect them to be maybe coming in the next couple of months, and also what buyers and people that want to move can do in terms of, the rates being a little bit higher than they've normally been, even though you wouldn't say these are high rates, they're just higher than they have in the past 2 years. And so to help with the rate review, I have Joshua Rubin here today with me. He is the founder and president of Horizon Financial Group, Inc., and has been a top 1% loan originator since entering the business in May of 1995. He's done over $1 billion in closed loans. He has a degree in finance and attended Michigan State and Eastern Michigan University. Josh was committed to making the loan process as simple and clear as possible and ensuring that his clients' unique needs are met at the lowest cost and rates. So thank you, Josh, for being here. Greatly appreciate it.
Thanks for having me. I'm looking forward to this.
Oh, you're welcome. So the first question is going to be explaining how mortgage rates are impacted when the Federal Reserve rates change.
So great question, something I explain daily. So the Fed does not control mortgage interest rates. The Fed controls the prime lending rate, which would affect like car loans, credit cards, home equity lines of credit. Generally, mortgage interest rates will trend the same direction as what's going on with the Fed. But in reality, mortgage interest rates are determined by the yield on the 10-year Treasury bond and the mortgage-backed security market.
Okay. And as of today, where are the mortgage rates? And like I said before, would you say the rates are high or more traditional when you take out the years when it was, 3 to 4%?
So the average 30-year fixed rate since 1971 is over 8%. So in reality, they're still low. They're just not as low as they were during COVID. So for example, before COVID, you'd have a rate that would be in the high fours. Rates currently are the lowest they've been since January, and they're in the high sixes, depending on credit score and down payment. So they're still good. I will also suggest that October, they touched almost 8%. So rates are down significantly since the fall. We do expect them to continue to fall as the Fed starts to lower rates, hopefully in September.
Okay. And you kind of jumped ahead on one question, so I'll just ask now, what do you think they may be around September?
Well, so mortgage interest rates will actually fall before the Fed starts to lower rates. And the reason for that is because the bond market, which is how mortgage interest rates are determined, is very forward looking. So with where we're at today, it's already pricing in that there's going to be a rate cut in September. So you'll start to see bonds, start to see the price of the bond go up, the yield go down, and rates get better. That's already started to rotate right now. So over the course of even before they start to lower rates, you'll start to see rates improve. When they do lower rates, hopefully in September, as been forecast, you should see rates drop probably about 3/8 to that effect. Will be in the mid sixes, and then again they're forecasting one more rate cut in January. This is all predicated on economic. So interest rates and inflation move in the same direction. So as long as inflation continues to abate, you will see interest rates for mortgages improve. If we get an outlier, if we get like a PCE report, which is the preferred measure for the Fed in regards to what's going on inflation-wise, that might put those rate cuts on hold. You would see the yield on the 10-year Treasury actually go up, and you would see interest rates go up. So it's very, very data dependent, and it's something that can change daily.
Okay. So it seems like it's been an interesting market this year and last year for sure, where normally when the interest rates go up, usually home values come down, and that's not happened for, a variety of reasons. And so even though it's not as much of an aggressive sales market as it has been in 2021 and 2022, what's your perspective on the market, and what do you expect from interest rates remainder of the year?
So I do expect rates to fall, mortgage interest rates. I think that we'll be in the mid sixes by the end of the year, which would be an improvement. The reason why it's such an improvement is because it helps with home affordability. So like, for example, when rates were at 3%, if you borrowed $100,000, that rate would be about that payment would be about $420 a month. That same $100,000 now with where current rates are at is almost $660 a month. So that's where the affordability pinch comes into play, and it really affects first-time home buyers. What we've seen since May 1st is listings continue to increase. For sure, it's still a very much a seller's market, but we are seeing more houses listed. We're having clients that are having more success getting offers accepted. We're returning to normalcy, and that's all we hope for. No, it's not healthy for anybody to go through what happened during COVID. Let's just get back to a normal market, an equilibrium with buyers and sellers, decent interest rates where there's some affordability for first-time home buyers. That's what our goal is moving forward, is a little bit more normalcy.
Yeah, I mean that's the thing is I think that there's more homes for sale. I've listed a lot more homes recently. Um but I mean, what do you think, like when the rates decrease, do you think by that time we'll have enough, inventory to where it will still feel normal, or you think we're right back at aggressive again because the interest rates have gone down?
So we'll definitely see things won't change much, meaning that when rates fall, all that's going to do is bring more people to the market. And so unless there is an equal amount of new listings, which there won't be, you're going to go right back to where you were. I mean, that's why home prices, when people are on the sideline right now waiting for home prices to improve, that's not going to happen. And unfortunately, it's not going to happen because of supply and demand. There's still people that will scoop up houses. I do think real estate is getting priced more fairly. You're not seeing some of these ridiculous situations where, where they bought the house and 2 years later, they're trying to sell it for 200 grand more. I think those are kind of going by the wayside, and houses are sitting slightly longer if they're priced out of whack. The market is doing the talking, if you will. When a house is priced correctly and it's a nice house, there'll be multiple offer situations day one. It's when you have these properties that sit because they're priced too high, that's when it becomes an issue. When rates fall, without question, competition will heat up even more. So what we hope for is when rates fall, more people will list their house because they no longer have those golden handcuffs. Meaning all these people are at 3 and 4%. It's tough to give up that rate to go to a rate that's going to be in the high sixes. As rates improve, we should hope to see more inventory. Prices might stay the same or go up. I don't expect them to go down, but you will see competitive markets. But hopefully more normalcy, less appraisal waivers, less appraisal guarantees, less of everything. Normal is going to be my watchword for 2024 and 2025. Let's just get back to normal market. That's all.
Yeah, I mean that's the thing. It's just there's a lot of people that I have in my pipeline right now where there's not a perfect time for them because they want to move, So, in 2022, it was too crazy of a market for them to compete and sell their house when they get a lot of money for it. Now the interest rates are too high. And it's like, well, it's always going to be a caveat, which is more important to you. I mean, in my opinion, I'd rather be in a position where at least I get the most money for my house.
Well,
So
look
I
at
can move, right?
yeah. If they bought 2 years ago during that time frame, and let's say at that time the house they liked was $400,000, even with 7% increase over the last 2 years, which is a moderate amount, that house is now $430,000. So if they had bought 2 years ago, with where they're at, they would have already seen that appreciation, just normal sustainable appreciation. And so that's why buyers that wait are effectively, they're going to end up paying more for those houses down the road than they would right now. Affordability may improve as interest rates get a little better, but they're not getting any value when it comes to the longer they wait, that price of that house is likely going to be higher than it is right now.
Right. I was just going to say, so buyers waiting for interest rates to drop is not going to necessarily help them because they're going to have more competition and they're going to probably pay more out of pocket just to get the house.
Yep.
And same for people that want to move and sell their house. I mean, you're going to have one or the other. So, okay. So I don't know, you probably touched on this a little bit, but any changes you've seen in buyers as it relates to the mortgage rates, from 2021 and 2022 when everything was like, hot, and then now, what's the biggest difference you've seen?
So I tell you one thing we're seeing right now, especially since like May 1st, is now you have the ability to negotiate a little bit. Now you have the ability for more people to get in the market because there's more listings. We are absolutely seeing clients more successful in getting their offers accepted. There's a lot more houses on the market. I don't know where the price points lie. That probably more your area of expertise. But the biggest difference now is that people are making offers on houses and they're getting accepted. People still get beat out on occasion, especially depending on some of the communities they're looking in. It might be cash, it might be a ridiculous, appraisal guarantee. It's going to be impossible to compete with those, regardless of the situation, regardless of interest rates, regardless of the market. There's always going to be people out there that need to move, that have the wherewithal to be able to pay cash or otherwise. That's going to be the outlier as things move forward. Now that was regular. That was how things worked during COVID. Like, you had to go crazy in order to get an offer accepted. Those are the things that have improved significantly since May. And I hope that what's going on right now in the market is not just seasonal, or a mirage, if you will. I'm hoping that this is the beginning of a new normal cycle, where we can start to get, especially these first-time home buyers, into these houses.
Yeah, I mean, well, that's the thing I've been saying is, during 2021 and 2022, it didn't really matter the house for the most part. If there was a house there, it was probably gonna have some kind of bidding war on it. Whereas, now and last year, for me, my perspective is it really depended on the house. If they, the condition, the price, and where it was located, if you had two of those three things where they should be, then you're probably gonna have bidding war. But if you're missing, if you only got one of them, you may not get that bidding war. Or, instead of seeing 20 offers, you may see 5, right? Or you had to wait longer to even get several offers. And around this time it kind of shifts because people want to get into their they have kids, right? And school districts important, and like, oh, school's starting soon, let's just hold off again. But like you said, I mean, you're still seeing bidding wars. So but hopefully, I mean, this is much better than it was 2 years ago at the end of the day.
I'll tell you something else that's different. You are now seeing buyers who are getting offers accepted, who are taking the time to have the house inspected instead of waiving inspections and walking away. And I always tell my clients, when that happens, don't be discouraged. And sometimes the best deals in real estate are the ones you walk away from. You don't want to buy somebody else's problems.
Yeah, I mean, and the good thing too, even with the bidding wars that I've had earlier this year, um, we didn't have to waive the inspection completely. We had ways around of negotiating to address the inspection, but we still were able to have it and still walk away if we had to, which it may not have been that case, in 2022. Um, so a lot of people were around when the rates were about 20%, have mixed reviews indicating that, when the home values were 30,000, 20%, okay, well, that's $30,000. But if you think about it, like you said, inflation, I mean, 30,000 then, maybe that's 300,000 now. And then you put 20% to that. So, what are your thoughts on the rates near 20% to the near 8% that we had
I
last?
love a lot of clients now, their parents, when they bought houses in the 80s, they were paying 17, 18%. That was normal back then. So it's always funny when we have these conversations with their children, and they say, "Oh yeah, my dad said when I bought a house in 1982 that the rate was 19%." You're 100% correct. Like, the reason why rates were so back then is because inflation was the highest it had been until we recovered from COVID. And then we had that same cycle again, where we had inflation that was as high as it was back in the early 80s, when interest rates were at 18, 19%. I don't think we'll ever get to that position again, even if inflation were to spiral out of control. And the reason for that is because 2/3 of our country's GDP is the housing market. Like, when someone buys a house, they don't just move in and put their feet up. They go to Best Buy, they buy a brand new 65-inch flat screen. They're putting window coverings on. They're getting the house painted. They're changing all the fixtures. That's why the housing market is so micromanaged. And what we're going through right now is just a normal transition based on COVID. If COVID didn't happen, we'd be sitting at rates again. They'd be in the high 4s, and we'd have a very balanced market, and we would be in a normal market. We're just recovering from that right now. And the fact that it's an election year should also play into the fact that rates will likely improve, even just because of the election. Even if the Fed doesn't cut rates, because it is an election year and there potentially will be change in the office, that generally has what's called a flight to quality. And what I mean by that is, you will have other countries, corporations, insurance companies, just investors like you or I, who buy the 10-year treasury. As the price of the bond goes up, the yield goes down and rates get better. That will happen automatically, even if the Fed doesn't lower rates, because the fact nobody really knows what's going to happen come January. And so the best, safest investment you can make in this world is in the US Treasury market because it's backed by the US government. We're not going broke. So that's why it's such a, it's such a huge financial marker, if you will, or barometer as to what's going on in the economy is what's happening in the 10-year Treasury.
Okay. Um, People who are adjusting to higher rates and they've been within the last few years, adjusting to higher rates of how they've been within the last few years. There are some options that they can consider, such as a 2-1 buy down, using down payment assistance, buying down the rate, adjustable rate mortgages, and maybe other options. Can you explain what those options are and the differences between, and what may be best for certain buyers?
For sure. So first and foremost, in a normal market, we would have the ability to have a client take out an adjustable rate mortgage. That rate would have been fixed for 5 years or 7 years or even 3 years. In our channel, the wholesale lending channel, there really is no arms any longer. And the reason for that is because these lenders don't want to give a client any more impetus to refinance more than they already have. And what I mean by that is anybody who bought a house in the last year or who's going to be buying a house in the next 8 months is going to be refinancing that mortgage in the next 18 months. And so these lenders would rather give a borrower less incentive to have to refinance. If someone's on an arm, they're going to be more mindful of that. So again, like in some instances, I can get a client a better deal on a 30-year fixed than I can even get them on an arm if they were offered. Some unique programs. Again, you have a 1-0 buy down, you have a 2-1 buy down, you have a 3-1 buy down. They're tremendously helpful. They're really more prominent in the new construction world. And the reason why that's the case is because these builders want that price point as high as they possibly can, because then it's going to be a comp moving forward. So if they're building a subdivision and they're able to have houses that after the extras and everything else across the board are X, they want that purchase price to stay as high as they possibly can. So it's a comparable for them. So what they'll do is they'll incentivize, and many times they'll do a 2-1 buy down, where they will turn around and cover the cost of that buy down. This is not where somebody's paying points to buy down the rate. This is literally, if the market is 6.875 right now, that payment for that borrower for the first year will be 4.875. That payment for the second year will be based at 5.875. And then for the remaining term, however long they might be in it, the payment will be based on 6.875. Why that's important, and a lot of people miss this, that seller is putting up the difference between those payments. They're putting that money up and the lender holds on to that. So when a borrower makes their first payment that first year, and let's say it's based off of a 4.875 rate, the difference between the 6.875 30-year fixed rate that they actually have and the 4.875 rate that has been bought down by the builder, it is covered by the builder's money that the lender has. So they're subsidizing that. So the payment actually is the same. It's just the builder is making that payment for the first 12 months at the 4.875 difference, and then the 5.875 for that second year. And then for that third year, the borrower is making, and third year on, that borrower is making the payment based on that 6.875 rate. So it's helpful for affordability. Builders love it because the fact it keeps their price points high. Where we don't see it very often is buying an existing home. And the reason why we don't see it very often is because a seller does not need to incentivize anything for a buyer to buy their home. So a lot of it is smoke and mirrors. A lot of it is, hey, I can get you a rate that's 4.875. It doesn't really happen in the existing home market because they don't need to incentivize it like a new construction builder may. The other thing I'll suggest in that regards is, there are a ton of programs that have come out to help affordability. Like we have a 0% down conventional product, which is tremendous. A lot of these programs, though, are income limited, meaning if somebody makes too much money, they won't qualify. So we get calls all the time. Hey, I want down payment assistance, but I'm putting down 20%. Oh, and I make $100,000 a year. Great call, but they're never going to be able to get that down payment assistance because it's really designed for low to moderate income borrowers. Now, there is a cool program. It is by Freddie Mac. It is a special purpose lending credit, and it's based off the address in which the client lives in currently. So we have this cool eligibility tool We type in the address that they live at currently, and it'll tell us based on where they're at if they qualify for this special purpose lending credit. If they do, it's $5,000 for free. It's literally a $5,000 credit. They'll also give you up to $550 for an appraisal, and they also will pay for a home warranty. Again, income limited. If you make too much money, it doesn't work. But we've had 2 instances. It was the clients lived in Redford right now. They weren't buying a house in Redford. They just lived in Redford right now, and they qualified for that $5,000 special lending credit. It's great. It's a great program.
Yeah, those are awesome. I actually haven't heard of some of those, so it's pretty cool. Um, so you're a broker. I mean, obviously this is not on topic, but I think it's important to say because so yeah, you're a broker and there's different kinds of loan originators, there's loan officers, and then there's differences when someone actually works for a bank, how they operate versus, if they work for a mortgage company. Can you explain, the
Sure.
basics of those?
Yeah, so in the broker world, we're wholesale lenders is what we are. Okay, so as a result of that, like our company, we're online, with over 100 different lenders. Now, not all those lenders will come into play, but it allows us to make sure that we're getting the client the best deal that can be had. That's why the broker wholesale channel continues to grow, because we have so many different sources of capital. If a client banks at Bank of America and they walk into Bank of America, that's the only option. That's the only 30-year fix they have. If a client has a unique financial situation, that loan's probably not going to work at Bank of America. They're going to probably need somebody to go to bat for them to find a program that does work for them. What I like to explain, okay, is the fact that in the broker world, we're like Eastern market. Our flats of flowers are, let's say, $5. Okay. If somebody goes to retail, which would be like the Chase branch down the corner or Bank of America or maybe a credit union, that same flat of flowers is retail. So it's going to be more money. It's going to be like an English Gardens versus an Eastern market, just to kind of give you an example. So in the wholesale lending community that we're in right now, we have an advantage over many of these banks currently because of the breadth of products that we offer and the number of lenders that are available to us to make certain that we're getting our clients the best deals that can be had.
Okay. So we've been hearing over the last 2 years about date the rate, marry the house kind of thing. Which for most people who don't understand, basically they're saying just buy the house that you want and you can refinance later, even though the interest rates are high right now. What is your opinion on that?
I think it does make sense. I mean, it simplifies it, to a good catchy saying in that regards, but that is exactly what happens anyway, even if somebody doesn't say it. So, there are 90% of all mortgages were under 4%. So there was no refinance market. Now, all these houses that have changed hands over the course of the last 2 years, they're at higher rates. As rates start to fall, it is going to make financial sense for them to turn around and refinance to a lower rate. It's going to help affordability. The important thing is the fact that it's more than just interest rate. And what I mean by that is, let's say the rate is 0.5% better, but if a client has to pay $5,000 in closing costs to achieve that 0.5 point savings, they don't save $1 until they recoup the money they had to pay to get the lower rate. And so what'll happen a lot, especially with newer home buyers, is that when the refinance boom does begin, which it will, they're going to be come at from every different direction. Text, emails, they're going to be bombarded with advertisements. In our industry, if it's too good to be true, it's too good to be true. Right? We're all dealing with the same deck of cards. Okay? Interest rates are determined by the 10-year treasury and the mortgage-backed security market. So what matters is that interest rates are a commodity. It's the closing costs that really make a difference. And so when rates do start to fall, make sure that you're looking at the big picture, not just the interest rate savings, but how much is it going to cost me to save that money monthly, and when do I recoup? So most lenders that are originating loans right now, like ourselves, we'll put in writing that we'll cover our clients' bank and broker fees when it comes time to refinance, so that we can let them know ahead of time that we're looking out for their best interest, where they're going to be able to maximize those savings as quick as possible, because they're not going to take an extended amount of time to recoup the money they had to pay to get that lower rate. Very important.
No, that's good to know because that was one of my concerns too, was, sometimes if you refinance, you may not actually be saving when you consider all the closing costs and everything like that. So
It also strips the equities. I mean, keep in mind, when people refinance, they don't want to bring any money to close. So if they owe $200,000, but now they're refinancing and they have to reestablish the escrow and closing cost, their new loan amount might be $210,000 now. So even though the rate's going down, now they borrow more money. They also reset the clock to 30 years. So like if they've been in that loan for 2 years, in reality, they have 28 years left to pay on it. If somebody refinances, they start the clock to a new 30-year fixed. Now it's that much longer. It helps to save money, and if affordability and saving money monthly is the main cause of wanting to refinance, then it might make sense to reset that clock. But in a lot of instances, we'll lower the interest rate for the loan for the client. We'll keep the interest rate the same, but then more importantly, we'll keep the term the same. So if they have 28 years left to pay, we will structure the loan so that they still have 28 years left to pay. They're just paying at a lower interest rate and not going backwards. That's also another important fact when it comes time to refinance.
Yeah, yeah. No, that's awesome. So it's just making sure you know that's the right decision for you and what lender you're using, I guess. Um, so if someone's getting pre-approved and they're given an interest rate, is there still any option out there where they can kind of lock in their rate for a certain period of time if they, secure a house within like 30 or 60 days? Or is it still where until they've actually gotten offer accepted and they move past inspection, they've applied for their loan, that they can lock in their rate?
So there's lots of lock and look programs out there. Sometimes those come with a fee. Sometimes they don't. I will tell you, in this current market, it probably would not make financial sense for a borrower to lock in a rate now because we know inherently that rates are going to improve in the short term. Now, if we were having this conversation a year ago, yeah, absolutely, potentially locking in a rate while you're looking for a house may have made financial sense because we knew we were in a rising interest rate environment. In reality, if you're not on a program like that, like a lock and look program, that interest rate can't be locked in until loan application's been taken. So when clients are getting pre-approvals or they're looking at fee worksheets or cash to close worksheets or loan estimates, that rate is what that rate is on that given day. But if let's say if their credit score changes by the time they find a house, that could affect the rate. If rates move up or down, that could affect the rate. Depending on the down payment, that could affect the rate. So at the time of pre-approval, it's good to know the lender you're working with, where their rates are at, where their costs are at. They should absolutely get something in writing so that they have that to compare apples to apples. The other thing I will strongly caution, do not have your credit report pulled by everybody. Okay, the more it's pulled, the lower the score is going to get. There is no time period where you can do that where it doesn't affect the credit. And that could be the difference between qualifying for best rates and terms. Like in reality, best rates and terms are at a 780 credit score and above. There's not too many clients that have a 780 and above. So it's, guard that credit score with your life and do not have it pulled incessantly. A soft inquiry, that's great. That's a really good tool. And any professional, any mortgage professional before they issue a pre-approval should at least be doing a soft pull to make sure they can live up to their end of the deal, especially when they're issuing a pre-approval letter. But a hard inquiry, man, I would caution every single client, anybody who calls us, don't have your credit report pulled until you figure out which lender you're going to use. Those credit reports are good for 120 days. So in that sales cycle, when you get pre-approved, generally once that credit report is pulled, that client is safe. They're very likely going to find and be able to close on a house within that 120-day period where the credit would not have to be pulled again.
Okay, and to reiterate with the whole locking in the rate, so right now you have a buyer, they're not going to lock in their rate until they, actually secure the house and everything. And let's say they don't close on time to where their rate lock is expired, right? How do you determine if it's better for them to just wait and see if the rates change or if they should go ahead and pay to extend the rate lock?
So a couple things about that. So first and foremost, when we're in a potentially falling interest rate environment, many lenders have a float down policy, meaning that if we lock a loan today and rates get better throughout the process, we have the ability to renegotiate with that lender to get the client a better deal. The kicker is that not every lender has the same float down policy. Some of it, sometimes when that happens and you renegotiate, it is at a cost to the borrower where it may not make financial sense. We have two lenders. One of them has the most liberal float down policy in the industry. if we have a rate, let's say it's 7 1/8, this happened a lot. If we, let's go back 6 weeks ago, we locked a client at 7 1/8. By the time we closed, that rate was 6.875. It's just a matter of calling the lender. They will float down the rate automatically at no expense to me or to the client to make certain that we're getting the client the best deal that can be had. That's important, especially as rates continue to fall. Now, let's say you're in the normal process. When we lock loans, depending on when that close date might be, generally speaking, we're always going to lock for at least 30 days. If we know when we have a purchase agreement that it's not closing for 40 days, we'll lock for 45 days. When you get close to a rate lock expiration, we have the ability to extend that rate lock. Sometimes the cost is nominal, like 10 basis points. So on a $100,000 loan, it'd be $100 to extend it. It's nothing. We cover that on behalf of the borrower. But when you're in a rising interest rate environment, which thankfully we won't see hopefully for quite some time, it can get quite costly to extend those rates. One thing to consider is that a rate lock has to be expired for at least 30 days before the lender will let you relock it at current rates. So that's important. So if somebody lets a rate lock expire thinking, oh, great, I'm going to turn around and I'll get a better rate because rates are better, doesn't work that way. You had the rate lock has to be expired for 30 days at that particular lender to be able to get current market pricing. So in that instance, a lot of times that loan officer would probably change lenders. If rates fall enough, it might make financial sense to switch that loan from whatever lender they have it locked in at to a different lender so they can capitalize on best rates and terms for their clients.
Okay. Oh yeah, so I did already ask that question. I didn't know I asked that. I didn't know I already had that question on my list. So there you go. So what's your advice to sellers that want to buy another house but don't want to give up their low interest rate?
Well, so you'll hear about this a lot about assumable mortgages. In fact, some listings will advertise that mortgage is assumable. The kicker is, okay, there's only two types of loans that are assumable. They're government loans, either an FHA loan or a VA loan. Now, you don't have to be a veteran to assume a VA mortgage. An FHA mortgage is absolutely assumable. That takes time. So like if somebody were to go down that path, it could take up to 60 days, depending on how efficient the process is. There's not a ton of loans that are, or houses that are listed for sale right now that are going to be government loans and going to be assumable. So it's a great marketing piece. It's, it's a great tool, but in the reality of things, very, very difficult to find a listing that rate could be assumable at the current rate. The other thing is like, it's kind of like swap a lease. Like that borrower that owns the house, he's on the hook still until that mortgage is paid in full. People don't realize that. So that also sometimes makes it less attractive for that seller as far as that goes. They want to be done. They want to be done with the house because if they owe X amount of dollars and they're selling the house for X amount of dollars, that buyer who's assuming the mortgage has to make up the difference between what's owed on the current loan and what the purchase price is. And people forget that. So if a seller owes $100,000 and they're selling the house for $300,000 and the buyer is going to assume that $100,000 mortgage, they have to come up with the 200 grand. They have to come up with the difference between what's owed and what the purchase price is. So a lot of people don't realize that. So again, one of those things that's a little bit smoke and mirrors. It's cool if it can work out, but it's so limited on how many properties out there that would actually fit the bill that it's kind of a misnomer. It rarely happens.
Yeah, I actually had that last year. It didn't work out well. But I learned a lot about assumable mortgages. Basically, it was a condo that I had and wasn't, it wasn't expensive because it was just it was like a small rental condo. But I did have the seller check with the lender to verify that, get something in writing indicating that they're not going to hold him liable if, the buyer defaults. It was just such a horrendous process. I mean, if I have a buyer and you pre-approve them, I can call you and ask you questions right away. With this company, you have to call a call center, wait to hear back in about 48 hours just to get your question answered. My seller had to give me written permission so that they could actually answer my questions, and sometimes that expired. So, I mean, I think 2 months of the waiting process, because they mailed the buyer all this paperwork. They wouldn't email it. They had to fill out like a closing package, about 100 pages, make sure everything is there. Pay for, they had to pay like a $250 fee for them to review things, another fee, had to be in a money order, all this other stuff. Oh, and then my seller had to do something. It was horrendous. So basically, they got everything, and then 2 months later, they finally tell us, yeah, this is not gonna work. So it was just a complete waste of time. Now, what I did learn is that the person that was supposedly, really working on everything, he did indicate that, they were starting to get, well, the reason there was such a delay, he said, was because there were so many requests for them recently, and they're more common in commercial real estate, and that they that process was down to to a T, so it wouldn't take as long. But because people hadn't requested assumable mortgages in so long, they didn't have the staff for it or the infrastructure. But because they're getting more requests, they will soon have that in place. When is that going to be? I have no idea, but I would never want to do one ever again.
It becomes more prevalent, like if you're in a military town, you know what I mean? Like, where you have a military base, there's so many veterans there that there's a higher likelihood that a house can be assumed as far as that goes. And so you see that in Michigan, there's pockets for sure. There's plenty of VA borrowers and FHA borrowers, but it's not as prevalent as it would be if we were in a community that was the center of the community was the actual base, the military base. Most of those houses around there are going to be military personnel that are going to probably be on a government type loan, either VA or otherwise, even USDA, as far as that goes. So that's why it's not so often here. There's just not as many VA loans, in Michigan as there might be in Florida or other places that have a large military presence.
Yeah, my seller actually was a veteran, but for some reason, he bought the home on FHA. So it was possible, just you think he would have been VA instead. So the last question I have are, what scores and other factors does a buyer need to have the best rate possible, and what are the score ranges that determine the rate brackets that they're in?
Sure. So I'll tell you that interest rates don't vary tremendously by credit score. This is another myth. So, for example, we can get a client the same interest rate if they put 5% down or if they put 20% down. Okay, there's no difference in rate for the most part. Where there really is a rate break is if a borrower puts down 25%, that is absolutely going to get them a better rate than if they were to put down 20%. But from 3%, 5%, 20%, those rates are all the same. What changes is the amount of the PMI. So private mortgage insurance is based off of credit score. The higher that credit score, the lower the PMI. What a lot of people don't realize is the fact that, they've been taught, I don't have PMI, I don't have PMI, I don't have PMI, I'll put down 20%. But when you do the math, they have great credit. I mean, on a $400,000 loan, PMI might be $40 a month. If you think about it, you get to a certain point where that extra, let's say 15% that they're putting down is more valuable in their pocket than it is in their house. And the reason why that is because for every $10,000 that someone borrows or doesn't borrow, their payment's only changing by $65 a month. So if you're going to turn around and save, $130 a month, but you're going to put $20,000 additional, sometimes you get to the point where that 20 grand is better in your pocket or working for you than putting that into a house, especially knowing that they're likely going to refinance down the road where they'll be able to eliminate the PMI.
Okay. So do you have anything else that you want to add?
I appreciate the opportunity. I love stuff like this. I've been doing this for 3 decades. It's a passion of mine. So I always love the opportunity to be able to share and answer any questions you have. And having worked with you professionally, you are among the best. You're an advocate for your clients, and that's what I appreciate when we get to work together.
Okay. And so how can people reach you and your team?
So my cell phone is the best spot to reach me always, or online. You can apply online. I generally don't miss a phone call or text. So unless I'm with my family, I'm immediate, but I can be reached at 248-797-5206 or horizonfinancialgroup.com.
All right. Well, thank you so much for your time. Hope you have a good week, and thank you everyone for joining us, and hope you guys have a great day.
Thanks for having me.
You're welcome. Bye. If you've enjoyed watching this video and would love to stay up to date when I have more content like this or something similar that you may be interested in, please like and subscribe to this channel and click the bell so you get notifications. And I hope you have a great day.